Nandurkar, the India strategist at CLSA. He's addressing the press at their conference.
Several years, and finally we are seeing the healthy competition between different states to drive investment projects, to drive growth within the states and to drive job creation. These are all healthy trends for the longer run. The key investor concern or question at this point in time is, while all these things are quite positive on the macro side, why are the corporate earnings not looking up just as yet? And my answer to that is, the answer lies in these macro improvements itself. So while on one hand we celebrate inflation coming down, but clearly it has its own negative impact on the near-term growth. We've seen the nominal GDP growth decelerating from close to 15% a couple of years ago, now down to 8%. The low inflation and the policies driving low inflation has hurt the property markets, has hurt the rural markets. And so these are the two important segments of the overall economy which have considerably weakened, and I believe that has delayed the transmission of positive macro into micro or the corporate performance. But I believe it's a matter of time. We are seeing some initial signs of improvement already. If you look at the high frequency economic indicators coming through the last few months, some of those indicators have shown an improvement. Those indicators include the IIP, the industrial production numbers, the power generation numbers, or the fuel consumption, the tax collections. So while there are some indicators which are still lagging, but there are some which are showing some improvement, and that gives us confidence that we are in the process of seeing the initial signs of recovery. The recovery will be slow. The good part is that the market expectations or the investor expectations have also come down, has become more realistic. On the valuation front, we are looking at the market which is now almost at an average level or even slightly below average level. If we look at the last 10-year valuation multiples, and the corporate earnings cycle is at its all-time lows. So the corporate, the profitability as a percentage of GDP is at an all-time low. So I believe average multiples on low cycle earnings is actually not a bad deal, and we therefore expect the markets to deliver about 15% compounded growth over the next 2 years. We believe that the market returns could be back-ended, so it will not be like 15% in year 1 and 15% in year 2, because the key for the market performance will be the capex cycle recovery, which I think will be slow. One of the things which will delay the capex cycle recovery is the weak property markets. This is something which I don't think has been well digested by the investor community just as yet. But unless the property markets revive, the overall capex cycle cannot revive. So therefore the process will have to be gradual. But on an overall basis, we expect, as I said, about 30% market returns over the next 2 years. And the sectors that we like, where we have an overweight position, are financial services, autos, IT services, and where we are underweight are consumer staples, energy, pharma, among the other ones. So clearly in the near term, the stocks or the sectors that we like are the ones where there is greater visibility of corporate earnings, because we are still in the process of corporate earnings getting downgraded. I don't think we have seen the end of that. So in the near term, the focus should still be on the corporate earnings visibility. So our sort of stocks and the sector selection is also primarily focused on that. And when we begin to see bigger signs of capex cycle recovery or economic cycle recovery, is the time when we will add more beta to our overall portfolio. Thank you.
You mentioned that one of the key things that you're watching out is capex recovery, and your report talked about it. You're not expecting it for at least for the next 1 year. We're expecting only second half of FY17. So till then, do you expect the market to remain with current valuation?
Yeah, so the thing is, what I have also said is we are seeing some initial signs of recovery, but don't expect a full-blown capex cycle recovery at least for the next 1 year. Now, having said that, certain parts of capex cycle will pick up faster, certain parts will take longer. I believe that the infrastructure segments like roads and railways are probably showing better signs, and you will see, or you've been seeing some signs of improvement over there. But as I said, property is going to be one big drag which will take some time to recover. So so some segments we'll have to wait for longer, but some segments I think we are already seeing some signs.
So basically, you are saying that the government debt spending will lead to capex recovery initially, and later on other sectors will join. That your expectation is.
Absolutely, absolutely. So the government spending on the capex side is clearly rising, but I think the corporate capex and the household capex will take a bit longer. Corporate capex, I don't really see the need for from the corporate side to see a big jump in there, because the capacity utilization rates have been coming down, or like currently we are at like a 5-year low. At about 70% utilization levels. So unless the corporates see demand picking up and the utilization levels going up to say 75-80% or more, I don't think we are going to see much big pickup in the corporate side, and also with the household side as well.
So which are the key triggers that you're looking for the market has to go up?
See, for the market has to go up, as I said initially, the growth will have to be government led. So some of that is policy driven, some of that is the explicit spending driven. In the recent past, the government has tried to sort of address some of the key market concerns, especially on the power side. Just like a week or so ago. I think that's a very interesting reform or an interesting step from the government side. Aside from that, there has also been some developments on the PSU bank recapitalization. We will see how and when the money comes into the banking space on the back of that. So I think these are some of the signs that we're looking at. Also, I think one important event to watch out for will be the budget. Because that is the time when we will likely see some corporate tax rates being cut, which is something that the government has been talking about. So I think some of these things will help the corporate performance, without which the markets will.
What about the new FDI policy that was announced last week? You talked about properties. There was a big bonanza for construction, hoping to revive the real estate market.
Yeah, so I think the various initiatives the government announced on FDI are clearly the welcome steps. But apart from the media segment, where there has been some limits hiked from whatever level to the next higher level, say 49% and like 100% and so on, the FDI action in most of the other segments, including property, were more to sort of relax the existing restrictions. On property side, for example, there were restrictions on the minimum size, how long you have to hold that FDI and so on. So I think it's clearly a step towards improving India's ease of doing business. So trying to reduce the subjectivity, trying to reduce the hurdles for getting approvals. So in that context, I think this so these recent changes on the FDI side have to be viewed in that context. That the procedural bottlenecks have gotten removed to a large extent.
So Karan from govt India. So you mentioned corporate earnings is an area of concern. In that context, sir, do you see perhaps further scope for further downgrade as far as FY17 forecast is concerned, and particularly what sectors you believe have seen perhaps too much optimism?
So on the earnings side, I do expect that there will be more earnings downgrades. So if you just look at the recent trends in the last 6 months or so, we have seen earnings getting revised downwards by almost 7-8% cumulative. So it's almost like 1 to 1.5% per month. I think the next 3 to 6 months we will likely see more earnings downgrades, especially for FY17 as well. As of now, the consensus expects the earnings growth for FY17 to be around 20% plus mark, which could come down to say 15 to 16%. The segments where I see greater risk of earnings downgrades are more capex driven, like the capital goods or cement, also to some extent property, which is where I think you would continue to see some earnings downgrades.
So in terms of banking,